What's up guys, this is Gerard back to you with another tutorial video on taxation. So on this episode, I'm going to be talking about estate taxes here in the Philippines. So on this video, I'm going to be defining what estate tax is and also mentioning the update of estate tax rates after trainlaw, and then enumerating the list of allowable deductions for estate tax purposes, and then give you an illustrative problem of estate tax. So for us to understand estate tax, we should have a working knowledge on the concept of succession, along with the different property relations of marriages here in the Philippines if the decedent is married. Now, just a disclaimer, the things that I'll be talking about here are updates in connection to trainlaw. So therefore, if the decedent died prior January 1, 2018, then therefore the old tax laws shall be applicable. So to define succession, this is a mode of acquisition by virtue of which the property, rights, and obligations to the extent of the value of the inheritance of a person are transmitted through his death to another or others, either by his will or by operation of law. Whereas to define estate tax, this is a tax on the right of the deceased person to transmit his or her estate to his or her lawful heirs and beneficiaries at the time of death, and on certain transfers which are made by law as equivalent to testamentary disposition. Now take note, it is not a tax on property. It is a tax imposed on the privilege of transmitting property upon the death of the owner. The estate tax is based on the laws in force at the time of death, notwithstanding the postponement of the actual possession or enjoyment of the estate by the beneficiary. So the general format in computing estate tax is from the gross estate, deduct the allowable deductions for estate tax purposes, and then we'll arrive with the net estate. Multiply that with 6% to compute the estate tax due. So the valuation of gross estate of the decedent shall be determined by including the value at the time of his death, all of the property, either real or personal, tangible or intangible, wherever situated. Provided, however, that in the case of a non-resident decedent who at the time of his death was not a citizen of the Philippines, only that part of the entire gross estate which is situated in the Philippines shall be included in his taxable estate. Now take note, based on the update of trainlaw, if the gross estate is more than 5 million, the estate tax return shall require a certification coming from a certified public accountant. Now take note, the allowable deductions for estate tax purposes has been updated due to your trainlaw. So here are the following. First one, standard deduction has been increased from 1 million to 5 million. Claims against the estate, claims against insolvent person, unpaid mortgages, properties previously taxed, transfer for public purposes, the family home, and then amounts received by heirs under Republic Act number 4917. Now deductions allowed to non-resident estates. First one, standard deduction is only 500,000, and then property previously taxed. Next is transfers for public use, share in the conjugal property, and then tax credit for estate taxes paid to a foreign country. Now with respect to actual funeral expenses, medical expenses, and judicial expenses in relation to testamentary and intestate proceedings, they are now repealed under trainlaw. Another update is it's now allowed to withdraw cash from the deposits of the decedent provided the bank shall withhold 6%. So let's now go to the illustrative problem on estate taxes. So first problem is, a Philippine resident citizen died on January 2018, leaving a total of net taxable estate of 10 million. The Philippine estate tax due will be computed as follows. So the net estate of 10 million will be multiplied by 6%, so the estate tax due shall be 600,000. So take note of the date when the decedent died. It's January 2018. So meaning the computation of estate tax shall be based on trainlaw. So let's go to the second problem. A Philippine resident citizen died leaving a total gross estate of 22,500,000, which includes conjugal family home of 2,500,000. So take note, you have your total conjugal real properties, which is 4.5 million, and then total exclusive properties, which is 2 million, and then business net worth based on interim financial statements at the time of death, which is 15 million, and then proceeds of life insurance, 1 million. So the allowable deductions shall be the standard deductions, which is 5 million, and then family home, which is a conjugal property, so 2.5 million divided by 2, so 1,250,000, and then also deduct the share of the surviving spouse, which is 1 million, and then also include proceeds of life insurance, which is 1 million. So the total deductions is 8,250,000. So the net estate is 14,250,000, and then simply multiply that with 6% estate tax rate. So our estate tax due is 855,000. So the estate tax shall be filed within 1 year from the death of the decedent, and the BIR form 1801 shall be used. So if you found this video very helpful, please give it a thumbs up, and make sure to check out these other relevant content right here, and make sure to subscribe to improve your skills and knowledge in taxation. So this is Gerard. Have a great day.